are you buying off the secondary market, or are you originating with hard money loans, private money loans, that kind of thing?
Yeah, originating loans, basically fix and flip loans is part of it. Also, mezz debt. So, for people who aren't familiar, mezz debt or mezzanine debt is basically when you take out a loan on a property, it creates a lien. The person who gave you the money creates a lien on the property, and that lien is in first position, typically if it's a bank or agency debt like Fannie or Freddie. And then sometimes you need to put a loan in underneath it in a second position. And when you do that, it's called mezzanine debt. So we do like mezzanine debt. The reason is it's got a much higher interest rate because it is in a second position. And if you do good analysis, good underwriting, you can still be in a very safe position, but get a much better interest rate. And then sometimes it's we call it senior stretch, or you do both first and second position, so that you're in control across the board, but you've got kind of two different loans going on. So we like the higher interest rate loans, and you can do that in these types of fix and flips and development or mezzanine positions, things like that.
And if you wouldn't mind going a little bit deeper on this, how are these more attractive than the other assets in your fund?
Well, so for us, it's around what's our investor looking for? And so an investor that's looking for steady income at a fairly high rate of return in a pretty low risk position, like not much chance of losing it, that's where loans we think are a good place to be, and where we find our investors who want that. They want to be in the loans. Other investors, maybe it tends to be sometimes just, I wouldn't even say younger, but people who feel like they've got more years ahead of them and want to take bigger risks and bigger swings. They tend to look at some of these loans and say, geez, 10%, that's not, I get better options, in 15 or 20% doing development and some other things. And that's fine. And so we do have those in our portfolio too. They do tend to carry higher risk, and they usually that payout gets more back end loaded. The loans get paid out every month. Equity, you might get some payments every month, right? Sometimes you got to kind of get the building to a place where it can make money, and you start getting some distributions, but you don't really get those bigger returns until you're selling the building at some higher price point later. So to me, it's what is the investor looking for? Loans are great for steady income and lower risk, and development and value add apartments and hotel conversions. That's bigger risk, potentially bigger reward, usually loaded toward the back end of the deal.
I'm sorry. I don't know if I caught it, if I missed it. Are you originating these loans, these secondary market purchases?
We're originating them.
Okay.
Yeah.
And
yeah.
when you're originating, you said 10% loans, or in that range, after management. What kind of return is that after the expenses for the investor?
Yeah, we look to get our investors 10+%.
Oh. And how's that compare, generally to the other asset classes in comparison?
Well, so that the way I guess, look, every deal is different, and every result could be different. But generally speaking, the deals I see and the deals that we bring in, if you look at it from what is an investor going to get out of it, loans roughly around 10%. You talk about value add apartment buildings, you're more like 14, 15, 16%. And then development more like 18, 20, 22%. And that's just, where I see the market right now and the types of deals that are out there. And I would say that if you're seeing deals that look more aggressive than that, it's certainly a flag to take a look at what's driving those numbers. I think, as you know, anybody can make a deal look great on paper. It's can it be executed? Can it be delivered? How much risk is in it, right? I mean, you could take any apartment building, for instance, and decide that the rents are going to go up, 10% a year for the next 5 years and have it look absolutely fantastic on paper. But if that's not a realistic scenario, which it probably isn't, then, what the return that's projected doesn't mean anything. So, certainly, I wonder, do you see that, Aaron, where you are in Florida? I know Florida's had a lot of rent increases recently. Do you see deals out there where there's people are saying, hey, rents have gone up by 8 or 15% or whatever the last few years, it's going to keep going?